In 5 states across the country, property tax laws are structured in ways that can reduce the home equity of senior homeowners by $4,000 or more each year. Many seniors do not become aware of this until they receive formal correspondence or notice a change in their property records. This is not a conventional property tax matter. It involves a legal mechanism embedded in county-level tax codes that has been operating for decades in some of these states. A Supreme Court decision in 2023 addressed the most severe version of this problem, but meaningful gaps remain. In 2 of these states, conditions are expected to become more difficult for homeowners in the near term. Consider the position of a homeowner who spent 30 or 40 years paying off a house. The deed is in their name, there is no remaining mortgage. The reasonable assumption is that the equity in that property belongs to them fully. What many homeowners do not realize is that the rules governing that equity are not set by federal law. They are determined county by county in state tax statutes, many of which were written generations ago. In the 5 states examined in this video, those statutes still permit the government or a private investor participating in a government-administered tax sale to recover substantial equity that homeowners built over a lifetime of work. There is a document available at most county or town offices, generally costing under $75, that provides meaningful protection against the most damaging version of this mechanism in 4 of the 5 states covered here. That document will be identified before the end of this video. First, it is important to understand which states have these provisions and why senior homeowners with fully paid properties carry the greatest exposure. These laws do not primarily affect homeowners who are in financial difficulty. They tend to affect those with the most accumulated equity. Homeowners who manage their finances responsibly over decades can face the most significant losses. The case that brought this issue to national attention involved Geraldine Tyler, a 94-year-old widow who owned a 1-bedroom condominium in Hennepin County, Minnesota. She fell behind on her property taxes. The total amount owed, including penalties and accrued interest, was approximately $15,000. Hennepin County seized the property, sold it for $40,000, retained the entire amount, and returned nothing to Ms. Tyler. The county kept $25,000 in equity that she had built over many years under the authority of existing Minnesota law. For a considerable period, courts in Minnesota and several other states upheld this approach. The legal basis was that a homeowner who falls behind on property taxes forfeits the entire property, not just the amount of the unpaid tax. Applied to a home worth $400,000 with $10,000 in unpaid taxes, that reasoning allowed the government to retain the full property and all $390,000 in equity. I am Nancy, and you are watching Senior Support USA. Ms. Tyler pursued a legal challenge to that outcome. In May 2023, the United States Supreme Court issued a unanimous decision in Tyler v. Hennepin County, holding that this practice violates the Takings Clause of the Fifth Amendment. The Constitution requires that the government provide just compensation when it takes private property. Retaining $25,000 in equity to satisfy a $15,000 tax obligation does not satisfy that requirement. It is important to understand what that ruling did and did not change. The Supreme Court did not eliminate property tax sales. It established that the surplus equity remaining after the tax debt is satisfied must be returned to the former owner. A seizure can still take place. A tax auction can still occur. A home can still be lost. What changed is that the county must return whatever amount remains after the debt is paid. That is where a new category of problems begins. In Minnesota and the 4 other states covered here, the procedures for calculating that surplus, identifying who should receive notice, setting the window to file a claim, and determining allowable fee deductions are still being developed at the state and county level. Some counties deduct administrative fees of 15 to 25% before any surplus is distributed. Others require a separate court filing before a former owner can access the funds. If the filing deadline is missed, which in some jurisdictions can be as short as 90 days, The surplus may revert to the county. The Supreme Court addressed the most extreme form of equity loss. It did not eliminate the risk of equity loss through fees, procedural requirements, and expired deadlines. A reduction of $4,000 through these channels is a documented outcome in tax sales across these 5 states, even under the post-Tyler framework. Minnesota amended its tax forfeiture statute in 2024 to bring it into compliance with the Tyler decision. Surplus funds are now held in a state account, and former property owners may submit a claim within a defined time period. The claim process is not automatic, however. The county is required to send notice, but that notice is delivered to the address on file. For an estate in probate or a senior who has moved to an assisted living facility, that address is often no longer current. The notice is sent, the deadline passes unnoticed, and the surplus is retained by the state. This outcome recurs across all 5 states. Federal law closed the primary mechanism for equity loss. State-level procedures left secondary mechanisms in place. The parties who understand and use those procedures are largely investors who have experience with the tax sale system. The former owners whose equity is held in escrow typically have no awareness that a claim process exists. In Minnesota, a brief call to the county auditor asking whether your name appears on any surplus list from a tax sale in the prior 2 years is sufficient to address this issue. It is a call almost no one makes because almost no one is aware it may be necessary. Nebraska had one of the more consequential equity loss mechanisms in the country prior to the Tyler decision. The state used a tax certificate sale system in which private investors could purchase a tax lien, hold it for 3 years, and then apply for a tax deed transferring full ownership of the property to the investor. The original homeowner could prevent this by redeeming the property during the 3-year window, which required paying the outstanding taxes plus interest at a statutory rate of 14%. A $3,000 tax obligation could therefore grow to more than $4,500 before the redemption period closed. One documented case from the late 2010s involved a Nebraska homeowner who lost a property valued at nearly $200,000 over a tax debt of less than $6,000. The investor received the full value of the property. The homeowner received nothing. Following the Tyler decision, Nebraska revised its procedures to require surplus return. The tax certificate sale system itself, however, remains in operation. Investors continue to purchase tax certificates and collect statutory interest. A senior homeowner who falls behind on property taxes still faces a running redemption clock from the point of delinquency. The change is that if redemption does not occur and title transfers to the investor is now required to pay the surplus equity to the former owner. The calculation of that surplus is where the $4,000 figure becomes relevant. Nebraska statute permits the county and the certificate holder to deduct what are classified as recoverable costs from the surplus before distribution. These costs include attorney fees, title search fees, recording fees, and statutory interest accrued over the redemption period. In most Nebraska counties, these deductions average between $3,500 and $4,500 per case. A senior entitled to $20,000 in surplus equity may receive $16,000 or less after deductions are applied. This outcome is not prohibited under Tyler, which does not bar reasonable administrative costs. For a senior living on a fixed income, however, a $4,000 reduction in recoverable equity can have significant practical consequences. The most effective protection in Nebraska is being informed about the process before a tax delinquency develops. The state requires the certificate holder to provide notice at several points in the process, but those notices are written in legal terminology that most homeowners find difficult to interpret. They may be treated as routine mail and set aside. The redemption window closes, the deed transfers, and the equity is gone. A licensed real estate attorney in Nebraska, billing at the typical rate of $250 to $350 per hour, can review these notices and assess risk in approximately 15 minutes. That cost can prevent the $4,000 surplus loss, and if the redemption deadline has not yet passed, potentially the full equity loss. Nebraska also offers a homestead exemption for property owners over 65 with qualifying income levels. The exemption reduces the assessed value of the home or, depending on the county program, defers the property tax bill until the property is sold or transferred. The deferred amount becomes a lien on the property, positioned behind any first mortgage and not accruing at the higher statutory delinquency interest rate. A qualifying senior who applies for this program can avoid the certificate sale process entirely and retain the equity in the home. The application is submitted to the county assessor at no cost in most counties and can generally be completed in a single appointment. Utilization of this program remains low among eligible Nebraska seniors. Most are not informed of its existence. Their adult children are often unaware. Tax preparers may not be familiar with it. The county assessor has the relevant information, but is not obligated to raise it with individual taxpayers. The program goes unused while certificate sales continue to proceed. New Jersey presents a different structure, but the potential for equity loss is greater. New Jersey consistently maintains among the highest effective property tax rates in the country. Average annual property tax bills in counties such as Bergen, Essex, and Union range from $12,000 to $18,000 on a standard single-family home. For a senior whose mortgage was paid off years ago, that annual bill often represents the single largest remaining expense in retirement. When a senior in one of those counties falls behind on property taxes, the state's tax lien sale system activates under terms that differ importantly from Nebraska's. The interest rate on a delinquent tax lien in New Jersey can reach 18%, with an additional 6% penalty applied to the original balance. A $5,000 property tax shortfall can therefore grow to more than $6,500 within 1 year and to more than $10,000 within 3 years. Beyond the interest accumulation, New Jersey law includes a provision known as the abandonment doctrine. Under this provision, if a municipality determines that a property has been abandoned, the lien holder may initiate an expedited foreclosure process that reduces the standard 2-year redemption window to as little as 45 days. The statutory definition of abandonment is broad. A senior who has relocated to assisted living and left a home vacant for 90 days while family members assess next steps may have the property classified as abandoned by a code enforcement officer, substantially shortening the timeline for action. In a standard New Jersey tax foreclosure involving a paid-off senior home, the surplus equity subject to the Tyler framework can range from $20,000 to $50,000. Allowable deductions under New Jersey statute include attorney fees, which in expedited foreclosure cases commonly range from $3,000 to $4,000, plus accrued lien interest, the statutory penalty, and the municipal administrative charge. A $4,000 reduction in the distributed surplus is a foreseeable outcome in most New Jersey cases. The most effective protection in New Jersey is proactive filing before any tax shortfall occurs. New Jersey maintains a program called the Senior Freeze, formally designated the Property Tax Reimbursement Program, for homeowners over 65 whose household income falls below the annual qualifying threshold. That threshold is adjusted each year by the Division of Taxation and should be verified before applying. The Senior Freeze does not reduce the current property tax bill. It establishes the bill at its level in the qualifying year, and the state reimburses the homeowner for any increase in subsequent years. A senior whose annual property tax rises from $12,000 to $15,000 over 5 years receives a reimbursement from the state for the $3,000 difference annually. The application is submitted to the New Jersey Division of Taxation at no cost. The program requires annual renewal, and missing a single filing year resets the freeze to the current higher tax level. A senior who qualified at $12,000 and fails to refile 3 years later will have the baseline reset to a level that may be $2,000 or more higher. There is also a structural limitation. Reimbursement is paid by the state, not the municipality. The municipality continues to bill the full amount each year. The homeowner pays the full bill and awaits a reimbursement from the state. For a senior on a fixed income who cannot cover the higher bill in advance, this structure creates a practical barrier despite the program's formal value. A New Jersey elder law attorney at the standard rate of $300 to $450 per hour can review tax history and senior freeze eligibility in a single session, with the consultation cost typically recovered within the first year of correctly filed applications. Illinois had, prior to the Tyler ruling, one of the most consequential tax sale systems in the country. The state employed a combined certificate and deed sale structure in which investors could acquire tax certificates, accumulate interest at rates that in some counties reached into the high double digits annually, and convert those certificates into full property deeds after the redemption period expired. Cook County, which encompasses Chicago and accounts for a substantial share of statewide property values, was the location of the most widely documented cases. Homeowners in Illinois lost properties valued between $150,000 and $400,000 over tax obligations as small as $4,000. Investors recovered the full property value while former owners received nothing. Following the Tyler decision, Illinois revised its tax code to require surplus return. Homeowner advocacy organizations have noted, however, that the revision has limitations. The current statute permits the certificate holder to recover collection costs, attorney fees, and statutory interest prior to distributing the surplus. In Cook County, average deductions in post-Tyler cases range from $3,800 to $5,200. A senior entitled to $30,000 in surplus equity may receive approximately $25,000 after applicable deductions. The primary protective option in Illinois is the Senior Citizens Homestead Exemption, available to homeowners over 65 who occupy the property as their principal residence. It reduces the equalized assessed value of the home by an amount that varies between Cook County and the rest of the state. Tax savings typically fall between $400 and $700 per year, depending on the local tax rate. A more comprehensive protection is the Senior Citizens Real Estate Tax Deferral Program. Under this program, an Illinois homeowner over 65 with household income below the annual qualifying threshold may defer property tax payments entirely. The deferred balance becomes a lien on the property at a low statutory simple interest rate to be satisfied when the property is sold or transferred. The lien is positioned behind any first mortgage but ahead of unsecured creditors. A qualifying senior who uses the deferral program does not fall behind on taxes, does not enter the tax sale system, and does not lose equity to surplus deductions. The deferral application is filed with the county treasurer, typically in early months of the year, at no cost in most jurisdictions. Utilization of this program is low among eligible Illinois seniors, largely because it is not widely publicized. Many seniors also have concerns that deferred taxes will create complications for their heirs. In practice, the deferred lien at a low statutory rate is substantially less costly than the statutory interest charged on a delinquent tax lien, and the balance is resolved at the time of sale or inheritance without additional penalties. One additional item in Illinois warrants attention. Cook County maintains a disabled veteran standard homestead exemption that can meaningfully reduce the equalized assessed value for veterans with a service-connected disability rating above a defined threshold. This exemption is commonly transferable to a surviving spouse, but annual recertification with the county assessor is required in many cases. The recertification form is mailed to the address on record, which means a senior who is relocated without updating that record may lose an exemption worth thousands of dollars annually. A licensed Illinois elder law or property tax attorney can assess eligibility for all available programs in a single consultation, typically recovering the consultation cost within the first year of correctly filed applications. Massachusetts is the most actively developing situation on this list. The state has a long-standing property tax limitation law known as Proposition 212, which caps annual increases in property tax at 2.5% plus growth attributable to new construction. For many years, this cap provided a stable baseline for homeowners. In recent years, however, a number of Massachusetts municipalities have pursued a mechanism called an override vote. An override is a ballot measure that asks local voters to approve property tax increases above the statutory cap to fund specific projects, often including schools, public safety facilities, or infrastructure. Override measures have received majority approval in several Massachusetts municipal elections in recent years. For a senior on a fixed income in a municipality where an override passes, the annual property tax bill can increase by $1,000 to $4,000. This is not a loss of equity in the Tyler framework. It is a reduction in retained income resulting from rising tax obligations that the affected senior may be unable to influence through the standard ballot process. There is a separate issue receiving growing attention in Massachusetts. Several municipalities have begun exploring a property tax surcharge based on the appreciated value of a home above its original purchase price. This type of mechanism is being examined in connection with similar proposals in other parts of the country. As of early 2026, no such measure has been adopted in Massachusetts, but the discussions are active in town meetings and legislative committees, and homeowner organizations are monitoring developments. If this type of measure were adopted in even one Massachusetts municipality, it would create a legal precedent that other towns could reference. A senior who purchased a home for $150,000 years ago and has seen it appreciate to $700,000 would face a tax obligation on $550,000 of unrealized appreciation. At a 1% rate, that amounts to $5,500 per year, payable in cash on equity that the senior has not converted to income. The principal protective filing in Massachusetts is the Senior Circuit Breaker Tax Credit, available to homeowners over 65 whose annual property tax bill exceeds a defined percentage of their income. The credit limit is updated each year and is claimed through the Massachusetts Department of Revenue as part of the annual state income tax return. There is no application fee, and the credit is refundable, meaning that a senior who owes no state income tax will receive the credit as a direct payment. The additional option is the local property tax exemption for seniors over 65, referred to as Clause 41, which is available in most Massachusetts municipalities. The benefit amount varies by town, generally ranging from several hundred to a few $1,000s per year, and the application is submitted annually to the local Board of Assessors at no charge. Together, the circuit breaker credit and the Clause 41 exemption can offset between $2,500 and $4,400 in annual property tax obligations. The document referenced at the beginning of this video is a homestead declaration. In Massachusetts, it is called the Declaration of Homestead. In Illinois, it is the Senior Citizens Homestead Exemption. In Minnesota, it is the Homestead Classification. In Nebraska, it is the Homestead Exemption. New Jersey is the only state on this list that does not have a comparable statutory homestead protection of the same scope. A homestead declaration designates the property as the owner's primary residence and, in most states, protects a portion of the equity from creditors and from forced sale. In Massachusetts, the protection commonly extends into the hundreds of thousands of dollars. In Minnesota, it covers a substantial portion of equity for a primary residence on a qualifying lot. Filing fees at most county offices fall between $35 and $75. The following 5 actions are worth taking in the near term. First, determine whether you reside in one of the states discussed. If you live in Minnesota, Nebraska, New Jersey, Illinois, or Massachusetts, your exposure under the mechanisms described is highest. In other states, equivalent protective filings exist under different names, and the Senior Homestead Exemption is the most common starting point. A licensed real estate attorney or county assessor can confirm your eligibility. Second, file the homestead declaration at your county or town office. For most seniors in the 4 states where it applies, this is the single most effective protective filing available. It is generally a one-time submission and typically extends to a surviving spouse. Third, request your most recent property tax assessment from the county assessor and compare the assessed value to recent sales of comparable properties in your area. If the assessed value exceeds fair market value, consider submitting an abatement application. There is generally no filing fee, and a successful abatement commonly reduces the annual tax obligation by $400 to $100 or $200. Fourth, inquire whether your state offers a senior property tax deferral program. Illinois, Nebraska, and several other states permit seniors over 65 to defer property tax payments, with the deferred balance becoming a lien at a low statutory interest rate, satisfied at the time of sale or transfer. This option can preserve equity during retirement and reduce the financial risk to heirs from a forced sale. Fifth, schedule a consultation with a licensed elder law or real estate attorney in your state. Standard fees range from $250 to $450 per hour. In a single session, an attorney can address homestead filing, deferral program eligibility, surplus claim procedures from any prior tax sale, and estate planning options for protecting equity in case of incapacity. The cost of the consultation is typically recovered within the first year of correctly filed applications and exemptions. The underlying structure in all 5 states follows the same pattern. Equity is not lost in a single event. It is reduced gradually through accumulated fees, procedural deductions, and overlooked filing requirements. The response is a series of administrative steps, most costing under $100, that together provide protection against the $4,000 or more that would otherwise be absorbed by procedural costs. Subscribe to Senior Support USA for continued information on protecting the assets you have spent a lifetime building.